Do discount points make sense to the borrower? We're going to do a side-by-side rate analysis with discount points. Let's go ahead and get the slideshow started here. So I'm Carl, the Money Nerd. I'm a realtor, mortgage broker, and a landlord. I can be reached at 720-732-4167 if you have any questions. This is not intended to be legal, financial, tax, insurance, and/or real estate advice. This is intended for educational purposes only. Please consult your attorney, loan officer, CPA, insurance agent, financial planner, and/or realtor for such advice. My NMLS number is 1254488. So let's go ahead and start digging into this. So what is a discount point? So let's talk about par rate. Well, par rate is the rate you would be charged with no discount points being paid or received. So in other words, you're not going to get any money back from the lender. The lender's not going to, you're not going to give the lender any money. If you want a lower rate, you could pay a certain amount of money up front and then be charged a lower interest rate for the life of the loan. This is referred to as a discount point. The opposite is also true as well. If you want to receive money at closing to cover closing costs, you can agree to accept a higher interest rate and be given money toward the closing costs. Why would somebody do either of these scenarios? Well, let's dig into it. Reason to pay for a low rate. It will save the borrower money over the life of the loan. You pay a discount rate, you're going to have a lower rate for 30 years if you do a 30-year mortgage, 15 years, whatever term you decide to do. The borrower in some cases will qualify for a larger loan based on the income they earn. So let's say, for example, the borrower only qualifies for, say, a $450,000 mortgage. They want to buy a $470,000 home. They pay a discount rate. They get things a little bit lower. They now qualify for a $470,000 mortgage by maybe paying a reasonable fee to lower their rate. It might make sense to them. It gets them into a little bit nicer home. In some cases, the seller is going to be willing to pay points and/or closing costs to attract a buyer. We're seeing this happen a lot more in the current market. A year or so ago, at least in the Denver market, you couldn't get the seller to pay for anything. You had buyers willing to pay over the appraised value, waiving inspection, doing all kinds of crazy things to get a home under contract. Well, the tables turned. We are in the process of transitioning from a seller's market to a buyer's market. Technically, we're still in a seller's market, which would be an indication of we don't have enough inventory to meet demand. However, inventory is building every day, so it feels more like a buyer's market. We are seeing this in particular in the Denver market. Not a lot of people are selling, nor are a lot of people buying. When interest rates go up, the buyer pool typically shrinks some, so you have fewer and fewer buyers. And then you have fewer and fewer sellers. A lot of sellers don't want to sell. They're sitting at 3% on their home, and they're looking at getting a rate in the mid sixes on the home they want to purchase. So they have to absolutely hate the home they're in or have to move for some other reason. In some cases, even if they have to move, they're still keeping the home, keeping the mortgage, and turning it into a rental property. It cash flows, and maybe they're going to rent somewhere else, or maybe they'll come up with some money from some other sources and have a down payment for another home. So as a realtor, I've met with a fair amount of sellers or would-be sellers that said, hey, I think I might want to keep my home. Maybe I want to sell it. After I'd have a discussion with them, talk about what I thought they could rent it for and stuff like that, they decided, I'm going to keep it. And we're seeing a lot of people become landlords just because they don't particularly want to give up their home. Maybe they're moving at a client that was moving out of state, got a new job. They wanted to make sure that job was solid. They didn't want to give up their home here in the Denver metro area. And so they decided to rent a home out of state for a while, want to make sure they liked the new job, liked the new state. They didn't want to come back to Denver and be trying to buy the same home at a higher interest rate. So we're seeing that happen. You've seen that also where people are moving across town. They're moving, say, from Arvada to Littleton, and they take their home in Arvada and they say, hey, I really, really don't want to give up this great rate. So they view that as part of the value of their home, is having a low interest rate, and they can make it cash flow, especially if they bought it, quite some time ago, maybe refied it, lowered the rate. So typically this works really well to have the lower rate if you're not planning to pay a lot of extra on the loan. If paying a little here or there, that's not going to make a material enough difference in most cases. If you're paying $50, $100 more a month, but if you're paying, $5,000, $6,000 extra a month, you're throwing in $20,000 chunks. maybe you don't want to pay for the buy down if you're going to pay the loan off fairly quick. And you'll have to kind of evaluate that case by case. Reason you would want to pay for another reason is the borrower believes that rates will be higher in the future and feels good about the lower rate. You know, they may think, hey, rates are only going to go up from here. Some people believe that. I think it's a kind of a wild card. It's an unknown to a certain extent. Here's my advice: do not buy down if you plan to sell the home in a short period of time or are going to pay the loan off shortly after closing. You know, maybe you're going to be selling a home somewhere else and you're going to have several $100,000 in proceeds. You're going to pay this down significantly, or, you know, hey, this is only going to be a home you're going to live in for, say, maybe 2 years. You're, you know, planning on moving. Maybe you're in a job that's upwardly mobile or something, or maybe this is just a starter home and you have no desire to be a landlord. You know, you have to kind of evaluate case by case. So let's go to the next slide. Reasons to take a higher rate and get the lender to pay for closing costs. It will save the borrower money up front. If you're really tight on cash and the only way you can get in the home is to get the seller, or not the seller, but the lender to pay some of the closing cost, this might be a really good scenario for you. You'll need less money at closing. That's a big benefit. You believe interest rates will be lower in the future and think that you can refinance it at a much better rate in the future. This may or may not be true. I have a friend who's also a loan officer, recently purchased a new home, decided to take the higher rate, get money back, pay all his closing costs, had a lot less money out of pocket. And he closes, and well, guess what? Rates kept going up, 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 up. And at this point, it doesn't make sense for him to refi. Now, if rates radically drop back down, he's probably going to be smiling, and he felt he made a good decision. If you're planning on paying a lot extra on your loan, you know, this might be a good idea. But if it's just going to pay a little extra, that's a different scenario. Do not do this unless you're comfortable with the rate and the terms for the life of the loan. There's no guarantee rates will go down in the future. So if you're going in and buying this home at a high rate and you're hoping rates go down in the future and they don't, you're stuck with that rate for the next 30 years or until you sell the home or refinance. But you may not be able to refinance to a lower rate. And so I would not bank on that. So let's go to the next slide. Let's talk a little bit about how interest is calculated. Interest is calculated on a monthly basis on most mortgages. There's some mortgages that are simple interest. Those are typically more commercial type loans, typically for investors. The majority of the mortgages you see on the market are typically calculated. The interest is calculated once a month. The mortgage uses whatever the principal balance is on the 15th of the month and determine how much interest is charged for the entire month. So let's just say you have a $500,000 balance on your mortgage and you're going to pay $30,000 extra down. If you pay that on the 15th or before the 15th of the month, your interest will be calculated on the next payment based on $470,000, not $500,000. Now, if you pay it on the 16th, you don't get to see the benefit until the next month. So if you pay it on the 16th, you might as well wait the 29 days and pay it on the 15th. Be careful paying on the 15th if you're paying via a check or something of that nature. If you're doing electronic payments where the money is directly, where you're on the lender's webpage and the money's directly coming out of your account, if you're sending a check in, I would not recommend sending it on the 15th. Send it in. Give it in this market, I'd say give it 10 days. The postal service tends to be a little slow at times. Bonus info. If you have a car loan, most car loans are simple interest loans, and the payment is, say, due on the 10th of the month, and you pay on the 3rd, you're going to save money. I've seen a lot of people that will sit there and they'll sit there with, you know, a couple $1,000 sitting in their checking account and their car payment's due on the 10th. And, you know, it's the 1st of the month and they've got, you know, $3,000 sitting in their checking account, and they're like, well, I've got to set up to automatically come out on the 10th. Well, you might want to go in there and cancel that automatic payment on the 10th, pay it on the 2nd. You will save some interest. It's not a huge amount, but if you do this consistently over a period of time, you'll save enough money to make a material difference. Next screen. Example of how interest is calculated. interest rate is say 6.5%. The loan amount is 500,000. The first month's interest will be 500,000 times 0.065 divided by 12 comes out to 2708.33. The monthly principal and interest payment is 3160.34. I use the payment function in Microsoft Excel to figure this out. There's a lot of loan calculators out there on the web. You can figure this out. You can ask your loan officer to help you figure it out. But it is basically a formula that the payment function uses to calculate it. But we won't go into the details of that. So basically 2708.33 is going to be the interest. So we're going to take the payment of the loan, which is 3160, minus the 2708, comes to basically $452. Your principal balance will go down. Take 500,000, subtract 452. Your principal balance goes down to basically $499,548, roughly. Then we take the new balance and we calculate this again every month. When we get further into this class, we'll look at some amortization schedules, and you can kind of see how that works. We're going to look at a sample of par rate with discount options. We're going to look at two different buy down scenarios, where the lender pays closing costs. For this, I put together an Excel spreadsheet to help people understand how this point works. So I'm going to share the Excel spreadsheet screen, and boom, and share. Okay, we should have the Excel spreadsheet screen up. So this is if you look here at the yellow here, this is the par rate, which is 6.363. There's no points either direction. The buyer doesn't receive a credit from the lender. The lender doesn't get a prepayment a discount point from the borrower. So in this case, the payment would be 3115. So I've highlighted in green a couple of different scenarios that we're going to go over. I picked what I would consider probably the most likely scenario someone would be tempted to take, which is the 5.999%. The cost to buy that down would be 0.819. That comes out to $4,095. The payment goes down by $118. Just on the simple straight front of it, lifetime savings is $38,000. Seems like a pretty good return on the money. And when I did this calculation, I took this amount, you see in the formula, I took this amount times 360 minus the discount. So that's how much you're going to save total. That's not, that is subtracting the cost. Now, if we go all the way down to 4.875, wow, we're going to save $138,000. And I'll talk about the pros and cons of going all the way down to that on the rate. It's going to cost you over $30,000 to do it, and stuff. So then the other scenarios we're going to look at is going to be two cases where we get money back. And I just picked two, what I consider likely scenarios. One would be, hey, you're just trying to get a little bit of money back to cover some of the closing cost, maybe just to bring a little bit less to the table. So you take 6.75. That's going to cost you $2,760 or 0.552%. It ends up costing $127 a month. The cost of that over the life alone is $43,000. The other would be, say, 7.125. You'd get 4805 credit back at closing, which would go towards your closing costs, prepaid, stuff like that. That's going to end up costing you $86,000. We can go all the way here. I mean, if you really wanted to, you could go all the way 7.875. I don't know many people doing this. You'd have to have probably some fairly extreme circumstances and other reasons why you might consider doing this. But there's always somebody has a logical reason why they do something. So, we're going to go and just take a look at the buy down. This is the buy down I think most people would probably be tempted to take. I think it's the most bang for the buck. It recovers fairly quick. So we're going to say you take a $500,000 loan out. The par rate was 6.363. The buy down, you can go down to 5.999. differential of 0.36%, cost you 0.819, cost you $40.95 in actual dollars. The payment differential, $118, lifetime savings, $38,000. Now, I decided for purposes of this class to assume, hey, if I had the extra $4,000, I might just take a smaller mortgage out. Let's assume that doesn't change anything else in this scenario. And then we're going to say, hey, the other one would be, hey, I took the discount and I took the rate, and so this is just a way to do an apples to apples comparison. So for purposes of doing this, the payment differential between the two is $92.48. Okay. This is where it gets interesting, and I'm going to show you more details. You'll notice I have months to pay off. If you made this payment on this loan amount at this interest rate, you pay your loan off in 332 payments. That's 28 payments saved. Total savings and interest and principal and everything over the life at that point would be $86,700. So huge benefit if you're going to make that slightly larger payment. It really saves you a lot of money over the life of the loan. So let's go look at the amortization schedule. In this case, we took the par rate, but we decided we were going to take a slightly smaller loan amount out, and we'll see that the $495,000. So the pay is $495,000. You take this, use the interest rate. It comes up with the amount that goes to interest, which was that formula I was showing you earlier. So you're taking this times the interest rate of the 6.3 something, whatever it is, dividing that by 12, gives you that much interest. Then the payment, the par payment, would be $30.8991. Subtract that. The interest, that's how much goes to principal. You'll notice every month the amount of principal goes up every month. Every month it goes up a couple dollars. Every month the interest goes down a couple dollars. And the reason is as you get further down the line, you're taking this smaller amount times 0.065 or 0.63 or whatever, divided by 12, it just comes up with a lower amount. It's kind of they call it the beauty of reverse compound interest, because it's compounding in reverse. If you were going the other way and you were trying to build savings, the same would apply. Every month you would grow. So I decided to do a balance differential. So the first month, let's just say 6 months from now, 8 months, whatever, called a year. A year from now, oh my gosh, you need to sell the house, and you did this program, you would be $2,500 lost. You would not recover that. So if you're planning to, let's say in 12 months, you think you're inheriting a small fortune, maybe you're optimistic you're going to win the lottery or something. I wouldn't bank on winning the lottery, but maybe an inheritance is something more reasonable to bank on. Or you're selling another house, maybe you're selling a business, something like that. Hey, you're going to pay it off. This may not make sense. But most people probably are not in that scenario. So you notice over time, you'll see the months. So this is 24 months in, you're only going to lose $831. And we hit month 30, so 2.5 years in. Now the savings kicks in. You notice every month it goes up and up, up and up and up and up. So let's go 5 years down the road. So 5 years down the road, we're saving, $4,600. Not bad. And going over the life of the loan, and remember earlier, back up to the top here, I had put the discount payment. So what I did is I did a function of NPER, and basically I take the loan amount, which is B4, and well, hang on, so kind of walk you through this. Okay, so I take the interest rate B4 divided by 12. B8 is, so let's go look at B8. That's the number of, B8 is the number of periods. Okay, that's the payment. Now this, I'm calculating the number of periods. Okay, B4 by 12. So basically I take F3 which is the payment we're going to make. And this stream of income basically pay it down in 332 payments. So you're going to pay it off 28 payments early. So this makes a lot of sense. Your risk is, reasonably low because, if you sell the house in 5 years, you won the game. As long as you keep the house at least 2.5 years, 30 payments, you're great. We go further down the line, you'll see it, the savings just continues to accumulate. And we watch this principal and we keep going. And you can see the difference over here gets bigger and bigger. But then we hit 332 payments and boom, we have now paid this entire balance down and we've basically saved roughly $80,000 approximately, and we've paid the loan off. I think most people would like to pay the loan off in 28 months early. But let's go to a more extreme situation, which is the buy down of 4.875. Now, I will just tell you personally, I refied my home in June of 2021. I chose to do a rate buy down. I paid, I want to say, over 3 points to buy the rate down. And that was a lot of points to pay. It was a fairly good sized mortgage, quite a big chunk of money. And that, of course, in my case, I was refining my home. So I actually ended up increasing my loan balance by the amount of points. So my loan balance went up, but I felt very confident that the rates were about as low as they were going to be in the summer of 2021. And I also felt like my chances of refining, again, I didn't really want to go through the process again. I wasn't sure what my income future would look like. I was planning on cutting back a little bit with work, so I was going to be cutting my hours down, maybe not making as much money in the future. So, and that's a case too, where, let's say you've got a salaried position, you're making pretty good money, you're planning to start your own business, or maybe you're planning on reducing your hours at work, cutting back to part-time. So these are some definite reasons to do a rate buy down, because if you may not be able to, the rates may be lower, but you may not qualify for the mortgage because your job situation changed. So self-employed person is going to need 2 years worth of tax returns to show that they're making consistent money. So by the time those all get filed, you could be 2.5, 3 years. I mean, that's assuming your business takes off and does extremely well right out of the gate. So, a person might say, hey, I want to really buy the rate down. And that may be a case where you decide you want to go down to this 4.875 rate, which is a huge buy down. It's almost 1.5% down, but it cost 6.15% in points. So the cost in points is over $30,000, but your payment is $277 cheaper. I made the assumption, and this is the same I did on the other one, that, hey, I would take a smaller loan amount if I had that extra money out, which you probably would. And my payment differential was $277. But you'll notice you get paid off in 293. Let's kind of take a look at this. Let's go down into the amortization of this. So same situation, we're starting with a lower loan balance. Let's go a year into this. Hey, we decide to sell. We just lost $25,000 if we decide to sell or refi or pay the thing off. So the break even. Now let's go to 30 months because that's where the break even was last time. Even at 30 months, you're still $16,500 in the wrong direction. So going. We've got to go to the 62-month mark before we see any real benefit of this. So if you're really confident you're going to be in the house 5 or more years, you're really confident you're not going to get a lower rate, or you're really confident that, or you may be, your situation is, hey, I'm planning on starting my own business, and it's going to be a few years before I get this back up and running. And even if rates went lower, I probably wouldn't be able to refi because I don't have the qualifying income that I used to. But we can see here, this starts really adding up quickly. We go and, go 10 years into this, we've saved $34,000 ahead, even though technically we started with a higher loan balance. And keep going. I'm going to put my cursor over here, and we're going to see that, hey, how that loan balance is going down. Look at that savings, how big it is. So we hit 292, 293 payments. We just went to, we've got $165,000 ahead of the game in terms of the balance differential. But then we're not even factoring in the interest savings. So I'm going to go back up here. When you factor interest in there, and if you had just been doing it the other way, you ended up saving $196,000. This might actually be worth it, once again, if you're not planning to leave the home, not planning to pay extra. So that's a potential scenario where that could make a lot of sense. I would caution people on this one just because it is such a substantial amount of money up front that I would want to know, hey, what's your scenario? But something you can talk over with your loan officer and discuss what you feel is best for you. So this is what I'm going to call a buy-up rate. And this is a case where, hey, we're going to do a $500,000 loan. In this case, I'm going to assume, you're getting basically your $500,000 loan, you're actually getting $2,760 extra dollars. It cost you some money in terms of extra payment. So in this case, your payment's $127 difference. This is similar to what we were comparing when we did the last scenario. I kind of walk through this real quick here. So, and we're going to look at the difference. So in this case, the balance difference is your money ahead. I'm looking at this and saying, hey, we're money ahead on this scenario. So in this case, this is the one where we're paying, this is $499,000. In this case, we're money ahead. So what happens is, in this case, I made this kind of a reverse of the other one, but basically for the first 16 months, let's say 12 months from now, we sell the house, or we inherited a bunch of money, or we sold another home and paid this mortgage down or paid it off. We might be winning this scenario. In this case, the other loan officer I was telling you about, he was making the assumption he'd be able to refi somewhere in this really quick period of time, come out ahead financially, and win the game. Caution on making that assumption that you're going to get a lower rate. So don't do this unless you like the rate. We're going to go up to the next scenario here, which is 7.125. In this case, we're getting $4,800 back. That would probably cover the majority of your closing cost. Once again, payment is, $153 more a month. You are getting $4,800 more. But it cost you $86,000. If you're going to make the payments the same, your $227,000 difference. So in this case, we had a little fun with this. Said, hey, let's just say if I was willing to make that higher payment. I'm going to make the higher payment on the lower rate. So I actually should have relabeled that a little bit differently. That should be, this should be the higher payment. And then this should be the par payment. So I'm relabeling that. There we go. Hope that provides some clarity. So we're going to go over here and we're going to just kind of play this balance game here. So, this person is winning for the first 15 months. So anywhere in here, he pays a loan off or something drastic, he's winning the game. Refis. But if he doesn't, look what happens. And I'm going to make the assumption he's making that higher payment. And boom, this just keeps getting crazier and crazier. And the cost is astronomical, how much this ends up costing you over the life of the loan. And had you made those larger payments, you'd have paid this thing off quite a bit earlier. So point being is, if you make larger payments on your loan, you're going to pay the loan off faster. So if you have any questions, feel free to call me. My number is 720-732-4167. If you like what I'm doing here, please subscribe to my channel. I'm planning on creating more videos talking about other types of issues relating to mortgages and talking about real estate as well and other financial issues. So thank you for watching.